Hello, everybody, and welcome to this public lecture of Tokyo College to be given by Pascal Saint-Amans on the International Tax Framework in a Fragmenting World. My name is Michael Keane. I'm an Ushioda Fellow and College Professor here at Tokyo College in the University of Tokyo, and it's my pleasure and privilege to moderate this event. So maybe just to say a little about how we're going to organize things today. So after I've introduced Pascal, he'll talk for 45 minutes, then he and I will chat and discuss for maybe 15 to 20 minutes or so. And then we're very much looking forward to questions from the audience. So please put those in the Q&A. It's a very unique opportunity to talk to Pascal, ask his views on these issues, now that he isn't speaking as an OECD bureaucrat, if I can put it that way. So maybe then to start by introducing Pascal, let me begin with the formalities, which are very impressive. Pascal studied at ENA in France. He joined the OECD, I think, in 2007, and soon after that took over effectively leading the work of what's called the Global Forum on Transparency and Exchange of Information for Tax Purposes, which is a long title, generally called the Global Forum. I'll explain what it is in a moment. Then from 2012, he became director of the Center for Tax Policy Administration at the OECD. He was there until, I guess, about a year ago when he left OECD, and now he's with Brunswick and a professor at the University of Lausanne. So that's an extraordinarily impressive CV, but it really doesn't tell the story of what Pascal has been doing for the last 15, 20 years. Really, over that period, Pascal has been at the heart of really a remarkable transformation of the international tax framework. He'll tell us more about that as we go through, in terms of efforts both to prevent evasion, cross-border evasion, particularly by high-income individuals. That's, putting it crudely, has been the work of the Global Forum. And then more recently, work on tax avoidance and trying to counter tax competition in relation to multinationals. And really over this period, I think where we are now, largely due to Pascal's own efforts, is really kind of unthinkable, I think, when Pascal went to the OECD and when I started to work on these issues. So it's been a really quite remarkable period. Really, there'd been no change in this area for about 100 years, and now the system has really been transformed. And there's nobody better to tell us about what has changed, why it's changed, how it's changed, and where things might be going to in the future. Maybe just for a little bit of context, I should add that for much of this period, I was Pascal's counterpart at the International Monetary Fund, the IMF. The IMF is very much a kind of a bit player, supporting role in this process, but took a close interest in the tax developments that Pascal was working on and leading. Like all good relationships, it had its moments of tension. But Pascal always handled that with great grace and effectiveness. So with that, I think I'll hand over to Pascal, just reminding you once more that please do feel free to put your questions in the Q&A. If they're in Japanese, I won't be able to read them, but someone will translate, and we'll be very happy to get to those. So with that, thanks, Pascal, for coming along, and over to you.
Thank you so much. Thanks for the invitation, Keen Sensei. Very, very happy, proud to address Tokyo College today and those who are listening to us. So thanks a lot for this invitation to try to describe what the situation of international tax is with this title, International Tax Framework in a Fragmenting World. And I'll try to tell you a story, a tale about how global governance was introduced in the area of tax, what it means. I understand you're not all tax geeks, so be it, lucky you, and try to make you understand what that means. I mean, tax moved from an extremely, or international tax moved from an extremely technical topic, which was of interest only to a few lawyers who understood it, and not many others, even in the governments. When I started in the French government back in 1996, I was in the international department, which was at the end of the corridor. These were the people traveling, speaking a language that nobody else in the tax administration, the tax policy would understand. This has deeply changed for the good, I believe, and I try to explain what has happened, under which condition, and what is next, because globalization has happened, global governance, I believe, has happened and has delivered in the area of international tax, but global governance is today at risk with decoupling, de-risking, and the geopolitical tension that we can see. So I try in three different parts to explain where we come from, where we are today, and what are the challenges of tomorrow. So we'll go back in history and start with a century ago, where the League of Nations was in charge of doing some work on tax. But before that, I would even be a bit provocative and say that there is no such thing as international tax. I mean, that's kind of a sick joke you do when you start a course on international tax to your students. You say, you know what, you've applied for a course where actually nothing happens. There is no such thing as international tax. Why so? Going back to the basics is because tax is at the core of sovereignty. We can go back to time, Egyptian time, but more recently, if we go to the modern era, you do have modern states in Europe in the Middle Age, which are built at the same time as emerges the concept of sovereignty, and at the same time as emerges the concept of consent to tax. So this is the context in which consent to tax, modern tax system in modern states was born. And because of that context, you can see that tax is at the core of sovereignty, which means that tax is primarily a domestic issue. When you deal with tax, you are in a pure domestic context. You design your system for your own people, and you have borders around that. And that's why there is no room in this world of sovereign countries for international tax. There was a change introduced during the First World War. You know, the history of tax is very often correlated with the history of wars, because when you have a war, you need to fund it, and therefore you need to increase the taxes. That's the story, by the way, if we go back to the Middle Age, of the war between France and England, which is the time where consent to tax appears and where the states are built. So during the First World War, you have the introduction of direct taxation, personal income taxation, corporate income taxation. For the first time, you have some cross-border dimensions of taxation, because countries will tax their residents on a worldwide basis, including on income that they earn outside the borders, and they tax the non-resident on the income which is sourced in their country. But you can hear, whether you're a tax person or not, that if you tax the same income twice in the country where it is sourced and in the country of the person which earns that income, which is a resident of another state, you have double taxation. And it's because of the emergence of double taxation, which was considered as not great to facilitate cross-border investment, that the international community decided to go beyond the pure domestic approach and to start an international approach to it, asking the League of Nations back in 1928 to put in place a model tax convention aiming at the elimination of double taxation. And that's the world which has been kind of stable for almost a century. Countries with their own domestic legislation, including direct taxation, for most of them, with some rare exceptions of countries not having direct taxation, and they will be called later tax havens, and countries taxing and having tax treaties to eliminate double taxation. Today, I think we have around 3,500 bilateral treaties. You can see that this has been very pervasive. All the countries move to tax treaties, and tax treaties were about how do you share taxing rights between countries. So each country has its own legislation, which prevails, including over a tax treaty. You first decide on your taxing right based on domestic legislation, but you can decide to limit your taxing right by concluding a tax treaty. And the tax treaties provide for who taxes what, but also when you have a multinational companies, corporate making profit in different countries, how to oblige this company to price internal transactions in a way which would result in each country getting its fair share. And the concept at stake is called the arm's length principle. That's about transfer pricing. And the idea is to oblige companies to price internal transaction as if these internal transactions were concluded with third parties at arm's length to decide what the right price would be. Finally, tax treaties come up with a definition of when do you become a taxpayer in a country. When you have a subsidiary, because you become a resident of the country, but if you don't, if you just have activities without incorporating in that country, and that's the concept of permanent establishment. So you can see that, to summarize this first element, tax is at the core of sovereignty, it's domestic. The emergence of direct taxation resulted in trying to bridge these tax sovereignties with tax treaties, which come up with some basic principles. How do we share the taxing right? How do we define internal transactions within group? And when do you start being a taxpayer in another country? And this world was the world in the 30s. Even during the war, you have people meeting to define what the new model tax convention should be. So you can see that tax people are not diverted by more important events. In 1946, you have again another meeting to decide on the model. And it's the OECD, which in 1955 takes over the Model Tax Convention and proposes commentary to it and some changes, but overall it's stable. The United Nations came a bit later in the game. I don't exactly know why, but in 1968, and they did their own Model Tax Convention between developed and developing countries. But that was the world. Good old times, would tax people say. Good old times where you had tax treaty negotiators traveling the world, negotiating bilateral treaties on the basis of the Model Tax Convention with slight changes, not fundamental, but depending on the trade flows between and investment flows between the countries they belonged, very small changes, but that kept all these people busy. And you had an industry of tax advisors, not that big industry, trying to implement the tax treaties. Well, that's the theory. In practice, actually, starting in the 90s, you have something fundamental. I mean, you have the Reaganomics, you have Thatcherism, you have a change of the ideology of the economy. You have, as a result, globalization. You have the financiarization of the economy. Later on, you will have the digitalization of the economy. What does that mean? That the world become, one integrated place, that multinational companies, which have always existed, but have become massive players, a number of them having a revenue bigger than the GDP of a number of countries. And in that world where economic borders were kind of removed one after the other, financiarization means that you have no more control of foreign currency exchange. The World Trade Organization follows a number of rounds, and you have facilitated trade. You have an increasing number of investment treaty, and you can move your money very easily. And not only the money, you can also move factories. You can move your labor force. So you can move capital, you can move labor, and it's a borderless environment. Actually, not completely, because tax remained domestic. And countries kept their tax borders. But the treaties, which initially were aimed to eliminate double taxation, started being used to locate your profit in places which understood that with globalization, they could attract investment. They could attract money by providing tax exemption. or preferential regimes. And in the 90s and in the 2000s, what you have massively is one, tax competition between countries. Usually tax competition or competition is for private players. Well, it was also true for governments. They started competing to attract investment, to attract real investment, substance, but also pure financial investment. And on the other hand, you had businesses taking advantage of that new environment to move to tax planning, more or less aggressive, depending on your culture. I'm speaking here in Japan. The culture is more about the contribution to society rather than aggressive tax planning. If we cross the Pacific Ocean, you will have another culture. Contribution to society, yeah, we should do it, but we have a fiduciary duty to our stakeholder. The less tax we can pay, the better off we are. With aggressive tax planning, which may have been legal or not, but you just try to do it as aggressively as you can. And this is the environment where we are in 2008, where there is the big wake-up call, and that's the second part of my presentation. The global financial crisis is a defining moment where governments across the world wake up, where until then they said we need to protect our sovereignty. We don't want to interact with other countries except with tax treaties. They realize that they have lost that tax sovereignty. There is a moment, which is the collapse of Lehman Brothers. We are in September 2008. The governments across the world wake up facing the risk of a complete collapse of the financial system. They need to bail out the banks. Tax havens have nothing to do with that. They're not responsible for that. The responsible players are in the US with the subprime that they blended in a number of financial instruments. But finance ministers across the world, and actually it starts before the collapse of Lehman Brothers, it starts in August 2007, where you have the beginning of the financial crisis. Governments across the world realize they will have to bail out the financial system. But if you bail out a bank, a Japanese bank, you also bail out the other banks because they are all together. But other banks, in particular Swiss banks, Credit Suisse, UBS, are helping taxpayers through bank secrecy not to pay the taxes that governments need to bail out the banks. Whether you're a right-wing finance minister, left-wing finance minister, you understand this is not possible. And where in normal times you will not seize the diplomatic relationship with a country not exchanging information with you because you have many other things at stake, with the heat of the global financial crisis, you have to take hard decisions. And that's where the OECD, which had worked a bit on that in the 90s at the initiative of the G7, under the leadership of Bill Clinton, who wanted to do a reform of healthcare and therefore needed some money and wanted to stop tax havens. So the OECD tried, but in 2001, it kind of stopped because the election of President Bush, who thought there were no tax havens, but just tax hells. And therefore, fighting tax havens was not good because it would remove the pressure on tax hells, which are not good. And that's very American, where you think that big government is not good and whatever funds a big government is not good. The OECD kind of stopped the work it started to fight harmful tax practices or to fight bank secrecy. 2008, with the emergence of the G20, with the heat of the financial crisis, is a wake-up call. Governments say, we have no choice, we need to stop bank secrecy. And that's where they turned to the OECD, which had worked on that, which was the only organization where you have governments coming and discussing standards, unlike the IMF, where there is no discussion of standards. So the IMF was absolutely key at that time. We remember the increase of capital and the essential role played by the IMF. But to develop a standard, countries turn to the OECD. What's interesting for this period of time is that it's at the same time that you have the emergence of a global governance with the G20. The situation is so serious that countries decide to gather. It's no longer the G7, as it had been in the 90s, the initiative of Bill Clinton. You have the G20, which include many more countries than the 7 most industrialized countries in the world, and they include the large emerging economies. Some of them are members of the OECD, Mexico, Turkey, Korea. Some of them are not. Argentina, Brazil, South Africa, Saudi Arabia, Russia, India, China, and Indonesia. I've just named the 8 countries which were G20 countries and not OECD countries. And these countries decide to work together to crack down on bank secrecy. And that's the first phase. Bank secrecy, for the reasons I've indicated, but also for, I would say, almost a more fundamental reason, which is with globalization, you've had an increase of wealth overall, but you've also have some transfers. And some people have felt that they lost with globalization. So you have some people who start getting angry, who think that globalization has also resulted in an increase of taxation of the people who are not mobile, labor. Because the taxation on mobile factors has tendentially decreased. So there is the feeling that something unfair was at stake with globalization. And the NGOs, the non-government organization, the civil society, have started campaigning for some years before the financial crisis on the fact that tax cheating, tax abuse, or just tax avoidance is not good because it undermines fairness. And if fairness is undermined, then the social contract is undermined. So when you combine these different elements, the financial crisis, global governance, the fact that you need to bail out the banks, and the background noise, which is that tax fairness is important, then you have the recipe for action. And this action will take place in 3 phases. The first phase is cracking down on bank secrecy. And this is done through a number of events, and some a bit nasty, like blacklisting country, but the OECD had the courage to blacklist some of its own member countries, namely Switzerland, Luxembourg, Belgium, and Austria. And I can tell you, it's not an easy diplomatic exercise for the Secretary General of the OECD, Angel Gurria, advised by me and my predecessor, Jeffrey Owens, to blacklist his own member. But that made the difference, and these countries decided to put an end to bank secrecy for tax purposes, to exchange information, because the technical way of exercising this principle of transparency is to give access to the banking information, beyond the banking information, the trust information, or the IBC, International Business Company information, so that you would identify who is the beneficial owner of the income or the wealth, and then get this information, and if asked, respond to the country, which so far was not the case for at least 50 countries. Switzerland would never exchange information. If a Swiss banker, an employee of a bank, would give the information to the Swiss tax authorities, he or she would have gone to jail. So we had to change that, and this changed. And what started with that is what I would call tax cooperation. Countries started cooperating on all aspects, including on financial aspects. And this was a massive change. The other element which was discussed at that time, and the IMF was pushing hard into that direction, rightfully so, was to say, this is not a question for only the G20 countries. And by the way, as I told you, the OECD held the pen, but you had 8 non-OECD G20 countries which said, we're not bound by this organization. We don't know the OECD. So how do you do? And how do you do in an environment where the small jurisdictions, which were the tax havens, those with no tax and with complete opacity, they were saying, you know what, we must be part of the game. Not like in the 90s where the OECD decided to hammer us without asking Switzerland to change. Now, Switzerland is changing, but we want to be part of the game. We need to level the playing field, which is absolutely essential if you want a global move to be accepted and implemented by everybody. And that's where the OECD was sufficiently agile to create a global governance mechanism known as, this is a very long name, as Mick indicated, the Global Forum on Transparency and Exchange of Information for Tax Purposes. Today, this body has 175 countries on an equal footing. It would have taken 5 or 6 years to do an international organization. It was much faster to do this with a trick, which was a part 2 program of the OECD status. Nobody's interested in that trick, but it worked, and it brought countries on an equal footing. So the OECD was agile enough to make it happen. I go fast on the other phases of this first batch of measures on transparency, because exchange of information on request was followed by automatic exchange of information, the Common Reporting Standard. This was held by the US, which took some unilateral measures as often, I would say too often, now that I'm no longer a diplomat, saying to the rest of the world, give me all the information or I hammer you with 30% withholding tax on all the income by all your clients. The US was successful. Other countries said we want the same, and they implemented the same via the OECD. It's known as the Common Reporting Standard. This means that all banking information is collected by the banks, given to the tax authorities, which exchange this information with all their partners. Not completely all. Developing countries are a bit behind the curve. They should get this information. But to give you a sense, last year, 140 million bank accounts were exchanged for a value which is, I think, above 11 or 12 trillion euros. So this is absolutely massive. Switzerland itself exchanged millions of bank accounts. That's the end of bank secrecy. Nobody believed it was possible, and it happened. And it happened because you had the blacklisting, because you had the commitment, and because the OECD was able to put in place a peer review mechanism. I mentioned that because in terms of global governance, peer reviews, I believe, are extremely important, because you're reviewed by the peers, all the other countries. You do a consensus -1, the country under review cannot object, but other countries can decide that you're good, you're not good, and if you're not good, you have some homework to do. And if you don't do the homework, we're back to another aspect of this global governance. The G20 will say you're a bad guy. If you're a bad guy, you're blacklisted, and if you're blacklisted, you lose income, you lose revenue, you lose investment. So that was the first batch. The second batch started in 2012. The crisis is still there. We've moved from the financial crisis to a fiscal crisis, and soon a social crisis, and governments are still concerned with tax havens. Some have said, the French president, les paradis fiscaux, c'est fini. Tax haven, that's over because of the end of bank secrecy. That was not the case. I'll give you just a number to make you understand it was not the case. In 2012, you had $2 trillion of accumulated profit of American companies in Cayman and Bermuda. $2 trillion. That's 2,000 billion of profit. At 35%, which was the rate then in the US, I believe it's around $700 billion of taxes which were not paid in the US. And that's what countries tried to address with their project on harmful tax practices in the 90s, and that they failed to address. That's what I described, the combination of tax competition on the one hand and aggressive tax planning on the other hand, which resulted in having extreme low tax rate for companies operating globally. And this was a massive problem. We told the G20 we can address that in June 2012 through a project that we named the Base Erosion and Profit Shifting. BEPS, that's a new four-letter word in English. I don't know whether it means something good or bad, but now it's in Wikipedia, it has its page, and it's a new word, BEPS, to fight this aggressive tax planning. But how do you fight it? Because it's legal. So when something is legal and you don't like it because the outcome is wrong, it's wrong to have $2 trillion of profit in Bermuda, what do? Well, you need to change the law. But what is the international law? Tax treaties, very hard to change because it takes years. It's bilateral negotiation, 3,500 treaties. Unless you can also say, well, these tax sovereignties, there are gaps between themselves, and that the tax havens are just taking the empty place, and they offer zero tax, and the money just flows down to the zero tax. Maybe we can better articulate these tax sovereignties. Maybe we can intertwine them not with tax treaties only, but also by reflecting the tax treatment of a piece of income in another country in your own legislation. Putting an end to what is known by tax people as hybrid mismatches. You had instruments which allowed to deduct something here and to be exempt there, which means that you could create tax credits because two countries would ignore each other. And the first batch of the BEPS measures was about to say you need to connect these sovereignties by reflecting what's happening in the other country in your own domestic legislation. And there were a series of measures: limitation of interest deductibility, the end of hybrid mismatches, the obligation to exchange tax rulings between tax administration. The second part was to fix the deficiencies of international tax rules, tax treaties which were abused. A quarter of the investment in India was coming from Mauritius. Guess what? It was not Mauritius money. And you had many other cases of treaty abuse which had to be sorted out. Same with this rule. You remember in the introduction, I mentioned the transfer pricing, the arm's length principle. Great measure when you have a brick and mortar economy, when you can decide what the price of the goods you manufacture in your own factory and that you distribute yourself. In a globalized world, where actually you outsource manufacturing and where the value is not on the distribution, but on the brand, on the intellectual property, on the intangible, precisely the intangible can easily be shifted from one place to another. And you don't have easy comparable. You don't know what the market price is. And in that world, the money goes with the IP, the intellectual property, in low tax jurisdictions. There was a need to fix this. The BEPS project said, we don't know where value is created, but what we know is where it is not created. It is not created in a no tax jurisdiction where nothing is happening. When you have just a trustee and you locate billions of profit, there is something wrong. So the money should go where the value is created. And BEPS was probably too shy saying, where is it created? Because countries were not in agreement. Capital importers, developing countries say, well, the value is created when we manufacture, maybe when we consume. Developed countries will say the value is created when we engineer the good, when we develop the brand. So there was a dispute there, and BEPS said, at least we remove it from the havens where nothing is happening. Finally, the BEPS project promoted more transparency. It was striking to see that global tax directors of multinational companies, they had, of course, the global view of their business. But tax administrations were limited to what's happening in their country and the bilateral relationship. In other words, Japan may have seen what was happening between Japan and China, between Japan and Singapore, but not necessarily what was happening between Singapore and Bermuda or Singapore and the US. And we said, member countries said, we want to do a global vision for the tax administration with a country-by-country reporting. Last in the BEPS project was the issue of the digitalization of the economy. It appears in the early 2000s, and very fast, you have scale without mass, as we say, meaning that you have companies able to operate at a global scale without mass, without employees. You can operate in countries without being physically present in the countries. But remember, the League of Nations rules provided for a company to be taxable only when it is physically present, when it has a permanent establishment, with a pretty precise definition of the permanent establishment. But with the global giant, the tech giants, this lost relevance. And a number of countries, primarily in Europe, a bit less in Japan and other countries, but European countries said, well, we can see massive profits derived from our economy by using our data collected through the search engine of Google or through the social network of Facebook or Instagram, or name it. So this generates advertisement, meaning revenue. By the way, the revenue is booked in a third country, Singapore for Asia, Ireland for Europe, and we cannot tax anything because there is no physical presence. It's wrong. We need to change the rules. And BEPS tried to address this, except that, and I'm coming to the end of the work on BEPS in 2015, 2016, there were successes and there were less success. I mean, the success was about putting an end to treaty shopping, making sure that you have the end of hybrid mismatches, that you have more transparency, that you have more transparency between tax administration, that you don't do rulings in absolute secrecy. That was very positive. But you had some weaknesses. On transfer pricing rule, what BEPS said was you need to put substance if you want to put profit. But after all, if you put 10 engineers in Bermuda or in Ireland, are they not the people in charge of the value of the company? So maybe with little substance, you can put a lot of profit. You don't realign the profit with the substance, which was the intention. You align the substance with the profit, which was not the intent. So that was a weakness. The other weakness was that on harmful tax practices, to fight harmful tax practices, you could see the limitations. You could see that countries were saying, okay, we cannot discriminate, so we'll reduce the tax rate for everybody, in particular for intellectual property. We'll link it to what's happening in our country, but we'll stop taxing it, because the value is in the intellectual property. And that's when the patent boxes were very successful across the world. Finally, BEPS didn't succeed on digital. On digital, the conclusion driven by the US was there is no problem. You guys, you are not successful. You are all developing countries, you European. You're unable to produce IP in the area of tech companies. So you're jealous, you want to do a revenue grabbing on American companies? No way. So we'll not talk about that until 2020, which created a lot of frustration because, believe it or not, this issue was very politically sensitive. And you have in the background, as I indicated, background noise of NGOs trying to say and saying loud and clear that the world is unfair and that the large multinational companies do not pay their fair share of tax where they operate. The outcome of all that, and I'm coming to the third batch of measure, the outcome of all that was a bit messy, especially us. And I'm going back to the title, I mean, the word in fragmentation. Until 2016, BEPS is successful, we deliver, we even create an inclusive framework for BEPS implementation, following the model of the global forum, where you have today around 145 countries to have a global governance. So it worked pretty well, but 2017, you have a few factors. Brexit, not great in terms of global governance. And what does it reflect? Financial crisis, fiscal crisis, social crisis, political crisis. People willing to recover their sovereignty, being angry. Brexit could be described like that. What do you have at the same time? The election of Trump in the White House, in the US. And Trump says, we need to stop trade. We need to stop being naive, and we need to have enemies, or we need to face our enemies. And that's where you can see the tensions with China and other countries across the world. So the global governance is not doing so well. I think a good illustration is the summit of the G20 in Hamburg in July 2017, where you have riots in the streets, and you have kind of a riot in the room, with Trump, if not insulting his colleagues, but saying, I don't want to communicate, I don't want a common approach, I don't agree with this global governance. Geopolitically, some tensions. From a tax perspective, you have, interestingly, two factors, two events. One is the fact that the French, who are known as the world tax champions and in all categories, and you can see global tax leaders are French. So we are really good at tax, and the French say, we're not happy with the Americans not allowing us to tax their companies. We're going to tax them through a unilateral measure. No global solution. We cannot tax at corporate income tax because there is no permanent establishment, and transfer pricing rules would not give us profit. So we will take 3% on the transaction, digital service tax, a tax on transactions. And not only do they do that in France, but they want Europe to do it. Actually, they start with Europe, and as they will fail to convince Europe to do it, they will ended up doing that domestically in 2018. But many other countries, the United Kingdom, in spite of Brexit, the Italians, the Spaniards, and a few other countries in the world, including India, say, we want to collect this tax. And as we cannot do it under the tax treaties, we'll do it unilaterally. And the US gets mad at Europe to say, if you do that, we're going to take retaliation measures, trade measures. And they did against the French. And of course, as the image of France in the US is cheese and wine and luxury, they did put tariffs on cheese, wine, and luxury bags. So you could see a trade tension resulting from a tax dispute. Tensions on the one hand. On the other hand, you have the US tax reform. Fascinating moment. Because the US tax reform, which was about slashing the rate from 35% to 21%, required to broaden the base, broaden the tax base. And to broaden the tax base, they explored two avenues. One avenue was to do the destination-based cash flow tax. I think we'll go back to that because I have one of the inventors of the destination-based cash flow tax, DBCFT, near me. I mean, Mikin is one of the fathers of the DBCFT. I mean, DBCFT is not completely born yet, but it's to come, I believe. So the US tried to do that. The idea was, let's use as a tax base for corporate income tax the sales in a country, the destination. And that's easy to understand for the US. The output is smaller than consumption, trade deficit country. So you broaden your tax base if you tax consumption. And by the way, the US doesn't have a VAT, so they don't really tax consumption. So that was a reason why the House in the US adopted that. The Senate said, too risky, because if you do that, you just blow out the international trade system. We can go back to the reasons for that later if you wish. So the Senate said, no, we need to broaden the base without threatening the global trade system. And then they called us at the OECD and said, you know, we did BEPS. Maybe we should do BEPS. And they did BEPS. But doing BEPS, they said, it's not enough. Hybrid mismatches, interested to complete, that's fine. We should do better. And they came up with two things. One is a global minimum tax. And with a great sense of humor, they call it GILTI, Global Intangible Low Tax Income. Republicans, who are supposed to be business friendly, call that GILTI and did put in place a global minimum tax of 10.5%. And they also introduced another measure with great sense of humor called the BEAT. And the BEAT, base erosion anti-avoidance tax, was about telling companies, if you shift too much profit abroad, Transfer pricing, I ignore. I will take a tax on that. Above $100 million of intra-group service payments, I'm going to refuse the deductibility of $1 out of 2. When you put these two different events, DSTs on the one hand, US tax reform on the other hand, you have a world which is a bit shaken, but though shaken, still working. The inclusive framework is there. The Germans, who export a lot and who don't like trade wars, say, why don't we talk about that? And believe it or not, in spite of the Trump administration being in charge, the tax conversation was going on. And that's where the two-pillar solution, which is the last batch, emerged. The two-pillar solution was to say, one, we must stop the bleeding. We must put an end to tax competition. We've tried with BEPS, we've tried with harmful tax practices, but we can see that substance is moving with the profit. So what we need to do is rough justice, like guilty, but better than guilty. The Europeans said, we can do a global minimum tax, but instead of looking at the average tax rate of a company abroad, you average France and Cayman, 30% or 25% and 0%, that's 12.5. We'll do it country by country. And the global minimum tax, which has been approved on the 8th of October, that's the new big date to keep in mind, the two-pillar solution. The pillar 2 is a global minimum tax, which was adopted with a rate of 15%, with an average, not global, but per country. And this global minimum tax was discussed during the Trump administration, who said, we've done it, do whatever you want, but then President Biden made it the top priority. He was very successful in getting it approved at the OECD by 137 countries. He failed domestically because Senator Manchin didn't follow him. But globally, there is a global minimum tax. And the pillar 1 was, how do we handle this digitalization of the economy? And there was a dispute between those saying, well, it's digital. We want to tax the digital companies, the American companies. And the Americans saying, first, under Obama, there is no problem there. Under Trump, because of the destination. You know what? You want to tax tech companies because you are markets. And you are right. Because we should tax more at destination. What you're doing is a move towards destination. And the Europeans say, no, 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 no. Because the Europeans understood, as they are big exporters, that destination would mean the transfer of tax to emerging economies, to large market economies. The Europeans said, no, no, we want to tax digital because it's special. You're collecting the data for free, so you need to pay us for the data. But we don't think that there is any problem when you export a luxury bag to the US or to China. And the conversation lasted 2018, 2019, 2020. And the conversation finally resulted in agreeing that it cannot be limited to digital, because there is no such thing as the digital economy. You have a digitalization of the economy. And when the Biden administration came in, while we kept this project alive in spite of COVID, in spite of the Trump administration, in spite of all the difficulties, the roller coaster of the diplomatic negotiation, when the Biden administration arrived, their priority was the adoption of a global minimum tax. They had to compromise on pillar 1, meaning finding a solution to reallocate taxing rights, not only on digital companies. And the solution which was selected was to say, we will reallocate taxing rights, we will share otherwise, for the largest companies in the world, whatever they do. The real problem is we are not satisfied with the way the rents are distributed in the world, because the rents are linked to intellectual property, intangible, which can be anywhere in the world. So as the intangible can be anywhere in the world, let's put the tax on something which cannot be shifted. What is the only thing that a company cannot shift? It can shift labor, it can shift capital, it cannot shift its clients, the customers. And that's where it was agreed that for the largest and most profitable companies in the world, above 20 billion euros of revenue, 10% profit, a percentage which was negotiated through days, months, hours at the last minute, a quarter of the rent will be allocated to the markets. You do the current system with the transfer pricing and you adjust it for a quarter of the rent going to the market. 8th of October 2021, you have an agreement among 137 countries in the inclusive framework of BEPS. That's where we were 2 years ago. Now I'm coming to the conclusion because I think we're running out of time. And the conclusion is, so what? I mean, the first lesson, so what and what's next? First lesson is we've had global governance on tax, and it holds in spite of the geopolitical crisis. Russia has been excluded from the inclusive framework or suspended, but otherwise countries are still talking to each other, are still working together. They have collectively adopted a global minimum tax, and the way the global minimum tax was engineered is such as even with China and the US not implementing it in their domestic legislation, it is happening. Why so? Because you have a critical mass of countries applying it, and the design is such that if a country where the multinational companies are incorporated, China and the US, does not take the minimum tax, the market countries will take it. And with Japan, Korea, European Union, UK, and Canada implementing the global minimum tax, you have a critical mass of countries. 1st of January 24, you have a safety net at 15% effective. Effective is very important. It cannot be manipulated. There is only one exception. If you have real substance, you can deduct 10% of the payroll, 8% of the assets, and these percentages will go down to 5%. That's a small room for maneuver for tax competition. Tax competition still exists, but is limited at 15%. Additional 200 billion euros to be collected per year, but more importantly, you stop the bleeding. Pillar 1 is not approved, and that's where we have some tension. The system, I would say, is probably not yet stabilized in terms of how you share taxing rights. It's not stabilized because Pillar 1 necessitates a multilateral convention. You need to change the tax treaties. You cannot, unlike Pillar 2, do it unilaterally in your domestic legislation. The problem being that this multilateral convention is out, but it has to be signed. And everybody knows that the US needs to ratify a multilateral instrument, an international instrument with a 2/3 majority in the Senate. They're not even able to find a majority in Congress in the House to elect a chair. How could they gather 2/3 to ratify a multilateral convention? Big question that all the countries have. But the solution is there. It's agreed, including by the US. How will you get there? How shall we get there is the question. I believe we're getting there. We're not yet there. But not getting there, countries which pulled the trigger of unilateral measures, which stopped then because of a multilateral negotiation, want to go back to that. Canada, New Zealand, and some others. So we may go through some turbulences. Nobody really wants a tax war. We have other wars, warm wars now. So we don't want a tax war. Nobody wants it. But on the other hand, the US may not ratify this. And that's why the multilateral convention is for public consultation for the next 2 months. We'll see what comes out of that. If US business says, we go ahead, that will be a positive signal. And Madame Yellen will be able to sign. If the US says no, maybe there is a problem. But what matters, if we take the big picture, is the system may not be fully stabilized, but it's in the right destination, and the destination is destination. There will be more destination taxation, whatever way is selected. Last word maybe for the fact that this agenda was not considered by developing countries as their agenda. This agenda had nothing against developing countries. It serves the interests of developing countries as well as developed countries. But developing countries were frustrated, still are frustrated. They think that a quarter of the rent is not enough. that there are not enough companies in scope, that the money that they will get is not enough, that the system is too complicated, and therefore they would like more. They get a subject to tax rule, which is part of Pillar 2, which will allow them to tax when an income is not taxed in a country or is taxed below 9%, but not enough. Not simple enough to administer. And I guess the IMF and Mick probably have things to say about the need to have more simple rules. Big frustration. And when you have the geopolitical tensions, you have dissatisfaction within the inclusive framework. And as a result, you have a push to the UN to try to say the UN should take over. And we'll probably discuss about that. I don't see the UN doing anything that the OECD is not able to do. Maybe countries will feel more at home, more comfortable, but the UN is not necessarily the place where you can reach consensus. And tax rules cannot change without consensus. You can say whatever you want. What matters is that you walk the walk, not that you talk the talk. So we are in a place where there has been an international tax revolution. There is now an international tax framework. It is a bit at risk because of the geopolitical tension. It is a bit at risk because of this gap with the US on the implementation of Pillar 1. But we do have tax cooperation. Countries talk to each other. Global taxpayers are facing kind of a global tax administration. They can no longer use the gaps between the sovereignty. And there is this safety net of 15%. The way the pie will be shared is not yet stabilized, but again, we probably move to destination. And that's where we are, many things to monitor. And the very last word is, there is more than corporate income tax in life. Look at carbon taxation, which I think is probably a big topic for the next 10 years. Look at personal income tax. The level of inequalities is such as wealth taxation, taxation of capital, maybe inheritance duties will be discussed one way or another. And they do have an international dimension because these issues are global. Climate change is global. They would require global solution. The fear I have is that the geopolitical situation may not facilitate further work. The hope I have is that it will not undermine the work which has been done. Thank you very much.
Thank you very much, Pascal. That's a really rich and full discussion and really conveys, I think, how much the world has changed over the last 15 years after more or less a century of very little happening in this area. It's been a kind of remarkable speed of change and I think progress. Maybe we can talk a little bit more about the process that you describe at the outset, because I think there is something to be explained, as you say, in that really things took off after the global financial crisis, even though nobody claimed that the bank secrecy or multinational tax avoidance had anything to do with it. And I suppose there's clearly one can see how the kind of the people who felt left out, you can see that builds some populist support, particularly for cracking down on the bank secrecy and the outright evasion by high income, powerful, prominent individuals. For multinationals, I wonder if it's a little bit more to explain in that, in some sense, if politicians simply wanted to appease some populist thing, they could just say, we're going to raise the tax, we're going to raise the corporate tax rate, blah, 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 which they didn't really do. They did go back, as you say, to look at the real structure. And I think, as you also said, there had been, in some sense, reform was in the air before the great financial crisis, partly with the OECD's report of 1998, EU Code of Conduct. So I'm wondering how far, in a way, in fact, maybe politicians used the populism as a kind of convenient cover for addressing the faults of a system that was going to fail. That I think many, even before the great global financial crisis, I think many people said, this system's broken. So I guess in that sense is whether the global financial crisis really was used by politicians as a way of addressing these fundamental problems, given, as you say, their fiscal needs. And also, of course, multinationals are kind of quite a nice political target, right? Because you can blame the evil companies for their perfectly legal, but their kind of mischievous ways of avoiding tax, when really, as you explained, all these opportunities were really created by governments themselves, more or less consciously. So maybe just to say a little bit more about how the process began and the role of the crisis, and maybe if I could add on to that. I'd be curious what you think the role of civil society has been in this process, which kind of sort of at two levels. One is the protest in the street level, and the other level, there's been, I think, some quite sophisticated work done by Tax Justice Network and others. So how do we see the role of civil society having played out in that? And then I'll ask about the role of academics as well, which you touched on.
Okay.
But maybe a little more on the how this really got going. Yeah.
No, thank you. I think you've said it, so
Yeah, okay.
I can just echo what you've said. You're right. I think there was a common understanding that the system was broken, at least by the professionals, by the tax community. Some would not have recognized it, but many people knew it. I can give you a very concrete example. At the OECD, when I joined in 2007, people had been working for 3 or 4 years on an aggressive tax schemes directory. So tax auditors from all over the world were meeting and we're sharing frustration, probably around a beer, but they were saying, okay, well, we found this scheme and it works. It's legal. We found this scheme, is it legal? So they were trying to dispute it and we're losing in court. So a gang of losers, if you want, but they were very frustrated. And that what that indicated was that the system was broken. It was legal. And the other thing you've said is absolutely true. It's very easy to say evil companies. They're bad. And they were not great in most instances by being extremely aggressive. I mean, when you call a cat a dog, there is something wrong. But if it's legal, why not doing it? And the real responsibility was with the governments. They let it go. Now, they let it go in part because they were not aware. International tax was this obscure office at the end of the corridor, right? Which I described. But they let it go also for more fundamental reasons. You wanted to promote your champions. The European Union building, maybe we should talk about that. European Union was built with something which is deeply wrong in the design. You had tax havens and the principle of unanimity. Unanimity, which brings us back to the concept of sovereignty, consent to tax, and the fact that governments don't want to give up their sovereignty. They cannot leave this to qualified majority. But think of it. You have a common market with no border. You remove all the borders. But you don't harmonize tax because tax havens don't want to harmonize tax. What happens? You cannot discriminate. You have no borders. You cannot treat differently a resident from a non-resident, basically, even though it's slightly more subtle than that in the legislation, in the EU legislation. The outcome is, in Europe, companies could put their profits in the less taxing country, least taxing country, Luxembourg, Ireland. And then, as if you didn't have enough tax havens, you invite Cyprus and Malta to become members, and you give them the key of the house by unanimity. So Europe let it go. Was it intentional or not? Maybe it's the reflection of the dominant ideology, free market. Then the US was different because they were taxing their companies globally. But in 97, they introduced accidentally in the legislation, not even the legislation, the regulation, check the box. Check the box is a way which was to help the plumber for hire to comply and which helped the large multinational companies to locate their profit in Bermuda using hybrid mismatches and so. And the US didn't repair this. They could have. It was not legislation, regulation. Why didn't they repair it? Because they said the European companies don't pay much tax when they invest abroad. Why would we shoot ourselves in the knee? So you had, for bad reasons, which are lack of information of the leaders, of the ministers on the aggressive tax schemes, but other reasons which are more pervasive or more serious, which is we do not want to harm the competitiveness of our players. And the result was that the system was broken, but nobody wanted to repair it. And the global financial crisis, I think, is an opportunity for government to do it. But I would put it maybe in a more negative manner. They had no longer choice. Because they could see the rise of populism. So they had to address that. And indeed, it's easy to put the blame on companies. So you had all these different elements, and if we go in the very precise timing, in June 2012, in the G20 communique, you have a line saying we, the G20, we reiterate our support to the OECD work on BEPS. Reiterate was a word produced by the Brazilians who didn't want to look like they didn't know about that. It was brand new, and I was the one who did that sentence because I was a drafter at that time of the communique on the tax paragraph. Okay, but governments were not really aware. My goal was to have a mandate to work on that for 5 years. In October 2012, 3 months later, 4 months later, this topic is on the top of the agenda of the G20. Why so? Because you have demonstrations in the UK against Starbucks, against Apple, against large multinational companies. And the Chancellor of the Exchequer, George Osborne, says, we must do something. And his team says, look, the OECD is doing BEPS. And that's where we receive a mandate to produce a report. And then it has become the hot topic of the G20. I can tell you, for having attended all the G20 meetings, when tax comes on the agenda, ministers wake up or they stop reading their notes and they speak their mind. So they were very much engaged in that.
And
civil society, sorry, you asked about, they played a key role to make people sensitive. You know, when I started, maybe you too, in the world of tax in '96 for me, and you were at a dinner, I don't do social dinners, but I was told that when you were at a dinner, people would say, well, I'm having money in Switzerland, or I'm not paying my VAT here, or so tax cheating was kind of a sport. Because of the role of NGOs and the civil society move to tax fairness, today, tax cheating is bad. It's not contributing to society. So there has been a change of perception which results from campaigns.
Yes, I mean, I agree, and I very much agree with what you're saying about the European Union. I think a real historic opportunity was missed by not focusing on corporate tax issues very early on, and instead focusing on VAT coordination, which is helpful and useful, but it's not so essential in that sense. And I agree on civil society. I mean, I think it's had these two strands that have made it very effective. I think it's had the people in the street, and it's had some technically very good people working on it, which I think gives what they say a lot of credibility. I think that kind of has really given them a lot of leverage, having both things, the street participation combined with completely respectable, you know, people who know their business as well as anybody. I think that's been important. But academics, you missed out the role of academic work.
So now I'm a professor. I'm an usurpator. I shouldn't be a professor, but I'm a professor. So I have to say a few things on academy. I must say that as a practitioner at the OECD, one, I didn't have time to read academic work, and very often the academic work is good for the next 2 decades, but not for now. That said, I have to say more. That said, there is one contribution which I believe will make the difference in the coming years and has influenced policymakers. That's this destination-based cash flow tax. I must recognize when I saw it, I was a bit skeptical. I was a bit annoyed because it was changing. I mean, it could be used to slow down the negotiation. When you're in charge of a negotiation with 140 countries, you don't want somebody, I mean, you don't want an academic in the room lecturing people and people listen and then they say, oh, maybe we should take another 5 years to reflect on that, right? However, you need smart ideas, and it's not the practitioners who can come up with the smart ideas. We can come up with quick fixes. So I believe that the destination-based cash flow tax is a very smart idea. Because economically it works. I mean, if not the destination-based cash flow tax, at least the move towards destination. And that has been a very important contribution. It came a bit late. You know, 10 years earlier would have been much better. because I think the idea really emerges in 16. Yeah, right, during the US tax reform.
There were things before, but yes, I mean, that's what
not as clear as what you came up with Michael Dover and Auerbach, right? But I think this contribution has helped shape what I call Pillar 1 and probably what will be the solution in the long term.
Okay. I see we're getting a few questions coming in, but let me maybe ask you a couple more things first. So one is, it's really quite impressive. How many inclusive framework members?
145, I did, yeah.
And how are there lessons on how you build some degree of consensus among a group that big? I can sort of see, well, you have the US and Europe standing off, but that still leaves like 100 other countries that have got to be signing on to this. I'm wondering, what are the lessons you learned from how to do that? And are they, for example, applicable to think about where we go on carbon taxation? I mean, how does it, are there just lessons of leadership and management and of how you actually get people to agree, something like this? And I suppose more, it's in my mind a little bit because I gave a paper earlier this week about how potentially everybody can gain from a minimum tax without any compensation. And one of the questions was, well, why don't you just arrange transfers between countries and everybody can be better off? And clearly that's not going to happen in the tax context. But how does these kind of agreements emerge, and what kind of, are there side deals going on that we don't see or that nobody sees, or how does it actually work among such a huge group? Because it's really, in a time when when multilateralism hasn't been progressing much, it's really quite something.
Let me be a bit of a cynical diplomat there and explain how it works in practice. I mean, you have people idealistic who say, oh, all that should be in a transparent room at the UN. And if it is not in a transparent room at the UN where you have the 190 whatever members of the UN, nothing happens. And frankly speaking, without being too Machiavellic, this is too naive to be meaningful. A real negotiation means that you need to have several dynamics. The first dynamic is everybody has to have a common interest to move, and if some don't, they need to be pressured. Right?
Yeah.
And how do you pressure? By having the big guys agreeing common objective. It's cynical, it's not fair maybe, but that's the reality. How do you put an end to bank secrecy to start with?
No.
Well, you have all the big guys saying, sorry, but we cannot suffer from it. Much more complex. And the cause, it's a good cause. It's a no-brainer, right? On BEPS, much more complex. You have among the G20 countries diverging interests. Well, there is a common interest. It should not be in Bermuda.
Yeah.
And you can do BEPS because all the big countries will agree. And again, it's a good cause. And that's where I think the NGOs didn't play a nice nor a good role by telling developing countries, it's not good for you. It was not necessarily their agenda that was right, but it was not bad for developing countries.
Yeah.
Right? Now, the last phase is this Pillar 1, Pillar 2, where actually you have divergent interests all over the place. But if you don't do it, you have a negative impact for everybody, right? So how do you conduct a negotiation? Very pragmatically, you still need something like an engine, which is the G20, something which will push. But you need to organize the negotiation with all the different constituencies. What are the constituencies? The large countries, China, the US, probably the G7 countries. But then you need to have Africa represented. So you need to organize Africa in a way where, to organize the participation of Africa in a way where it will be meaningful. And that's not easy because countries are sovereign. They don't want country X to speak on behalf of country Y, but they should. They should mutualize. And they have. I use the example of Africa because the African Tax Administration Forum, the leadership of Logan Ford, has been able to do this, take the best of the different countries and being able to be part of the conversation. And then you need to use the delegates. It's also about human beings, men and women. You have some voices who are more clever than others and who can help build the negotiation. And then you need to proceed by small groups. You will have the Indians talking with the Americans and the European on one topic. Then you will have the Africans talking to another group on another topic. And then you try to bring that together so that when you have everybody, you have removed most of the obstacles. Now, this is what has happened, but it takes a lot of time. There are many inefficiencies. It produces something and produces ownership. Maybe we should reinvent a way where you give the secretariat, you give to Mickey the role of designing the thing, and then you bring something which has been designed to the countries for them to renegotiate. Because when you do it from scratch, it takes a lot of time and it produces complexity. It's a bit like a parliamentary debate. The government arrives with a text which is relatively complex. After the debate, it's awfully complex because you need to reflect the views of everybody. So I think we have not been good at finding a dynamic where simplicity would prevail over complexity. And I think the modalities of negotiation may be responsible for that in large part.
Does that leave you optimistic or pessimistic on the carbon tax front? Because there, in some sense, there's a commonality of interest looking forward, but there's also a lot of history to deal with.
Pessimistic is unfortunately the answer. And the answer should not be no, but it is no for the time being. It's a truly global issue. Right? Everybody needs to work together. What is at stake is for humanity. I mean, right? It's a common
interest on some level.
It's a real common interest. And the views are very different. So there is room to exchange, there is room to discuss, but it's not happening. And it's probably due to the geopolitical tensions, but also to something which may be the DNA of a carbon tax. It's regressive. It's socially not accepted, if acceptable. And maybe we need, or you need, as economists, to do more work to make it more acceptable. I mean, the problem is France moves the tax, carbon tax from 47 euros to 100 euros. Everybody puts a yellow vest and go in the street. And it's more pacific than Ecuador and some other countries where you have riot and they out the government. So no, I'm not very optimistic. There is, I mean, I think somebody in Switzerland said, I like this quote, if climate was a bank, it would already be saved.
That's true.
And maybe we need more accurate awareness of the issue.
Also maybe it's the role of civil society in actually pushing for the carbon tax rather than
opposing it.
Basically. But let me see, we have a couple of questions here. So one says, I think that the purpose and the ideal thinking of Pillar 1 and Pillar 2 is good and understandable, but I think to implement this is very hard. Pillar 2 has many rules and has many information to be collected. It is a heavy cost. What do you think of this?
I think it's true. It's difficult to implement. There are many costs. And as I've just indicated, it could have been simpler. That said, tax is complex and tax must be complex. If it is not complex, it's unfair. Tax must reflect the different situations. Two, here we are designing a global tax base. I mean, think of it. You have 150 countries and they agree on a common tax base and common mechanisms to report the information. Now, the transition is probably costly and difficult, but once it's operated, it's actually better to do one global information return than 150 different returns, even though you keep the national taxation.
It is, I mean, suppose Pillar 1 were to happen. I mean, things would be excruciatingly complicated, no? Is that sustainable?
Not that much. I don't believe so.
Okay.
Because Pillar 1, so it's this reallocation of taxing rights. The mechanics is extremely complex, but it's like a Swiss watch, right? I mean, it gives you what time it is. And you don't need to know how it works to know what time it is. Once it's in operation, because pillar one is a formulary apportionment with destination. So formulary apportionment, you apply the rules, boom, you have the result.
Yes, I think the criticism would almost be that there are too many principles there. You have arm's length pricing still there, as you've said.
Yes.
You have an element of formulary apportionment still there. You have destination taxation there in some degree. You have the minimum there in some degree. So there's no shortage of principles, but whether at some point one has to decide between them, I don't know. I mean, it's true that it's a bit like, I think it was Larry Summers says, no, you don't really need to know how your personal tax works because you can just get TurboTax and figure it out and run simulations and whatever. But in a deeper sense, I think many people would find that isn't really a great way to run a tax system that, for many national tax authorities might not understand at all what's going on. But
so two remarks. One, I can hear the academic frustrated.
I take that as a compliment.
Yeah, it is with envy. But you have a transition cost, right? How do you move from one system to another? Can you have an agreement on we completely move from the arm's length principle to a pure formulary apportionment? No, because you need to transition. And countries where, or even developing countries, were reluctant to move away from the arm's length principle. And by the way, the arm's length principle for routine return should be simplified, but it works. You know, it's the 80-20% rule. For 80% of the transaction, it works. The problem is that 80% of the transaction will give you 20% of the value.
Right.
The rest of the value is on the intangible, and that's where you do the new system.
Yeah. I guess there's a question is, do we think that this is going to be the final end place where we go to this, you know, if it were pillar one, pillar two altogether, BEPS and everything else? It's kind of, we're going to have that for 100 years.
If destination is destination, right? Then you may expect some move, if not away from the arm's length principle on routine transaction, but for the intangible, probably a larger allocation based on the key.
Yes, I mean, that's in a way a convenient feature, right? There are various parameters you can play around with to shift, but including, I guess, the 15% ultimately, who knows? Let me see if there's, yes, so will the G20 continue to be an effective engine? So maybe let me add to that. I guess, so you talk about global governance, but that's wider than the G20. Global community is wider than the G20 or the OECD or even the inclusive framework. So I wonder if you could say a little bit more about the suggestions of moving the kind of role that OECD has more fully to the UN. Clearly, I suppose that there are, you know, people would worry about, well, it can be given to the UN, but practically speaking, things aren't going to happen on majority vote or whatever in the UN. On the other hand, maybe the UN does have a degree of credibility that, however much it tries, any OECD-led process is not going to have the same credibility. So, are there ways ahead, do you think, in this way that can give more comfort to more people than how things have been so far? Bearing in mind, I should say, the inclusive framework, I think, is a kind of remarkable development, and clearly something I think the world should treasure and build on. But sorry, that's my view so far.
So first, G20 is in crisis, obviously, since the invasion of Ukraine by Russia. There has been a fight or struggle to get communiques, and the G20 is about speaking. So if you don't have a communique, you don't speak, so you don't exist.
Right.
So there is a crisis, and the tension between the US and China clearly doesn't help.
No.
Let's see what happens with Brazil, which takes over the presidency on the 1st of December, and then South Africa. But clearly the G20 is no longer the driving force that it was, even though tax remains a success story of the G20. Second consideration, with this more global approach, is the UN the answer? I must say, loud and clear, that I'm shocked by the UN Secretary General report, which was commissioned by the General Assembly. African countries last November said, well, we want the UN Secretary General to let us know whether we could do more work at the UN, so be it. And this resolution was accepted because of the overall diplomatic landscape. But the UN Secretary General report is, frankly speaking, shocking. It completely ignores the progress we've reported. And I know we live in a post-truth environment, but not the UN. I mean, you cannot deny what was achieved, whether you like the place where it was achieved or not. So this is dishonest, and they don't need that to make their case. So that's the first comment which I have to make. I'm conflicted. I was in charge, so I can take it personally. I don't take it personally. I think it was not necessarily very smart to do it that way. So that must be clear. The third remark is nobody prevented, in spite of what some NGOs say, nobody prevented the UN to take the ball and run in 2008. We did it, and we delivered. And we involved developing countries. That's what the UN Secretary General report doesn't recognize. Developing countries are a majority of countries in both the inclusive framework and the global forum. In the global forum, it is true that we have been able to build a family. People feel at home. I must say that in the inclusive framework, I failed to make developing countries feel at home. So there is something which is not broken, but is not functioning well enough. Now, bringing it to the UN, will it solve the problem? Let's be serious for a second, and maybe I'm too cynical of a diplomat there. But at the UN, you also have, I believe, the US as a member, don't you? You have the European Union as a member, or the European Union member countries. You have Japan as a member. These countries will defend their interests, as developing countries will defend their interests, as they do within the OECD. It's just a larger crowd. Now, is a larger crowd better? Yes, in principle. That said, to be honest, do you think that the priority of Centrafrique is to send a delegate at the UN to negotiate? Isn't it smarter for African countries to mutualize, for European countries to mutualize their interest, to be smarter, to be more efficient? I believe so. So the idea to say, if you do not have all the countries around the table to negotiate, it's completely wrong. Yes, that's right in theory. In practice, let's be practical. Let's help developing countries. Or let's help them negotiate on their own interest. I'm sometimes a bit shocked by all these white men in Oxford speaking on behalf of developing countries. I never spoke on behalf of developing countries. I brought them to the table to negotiate. So what could the UN usefully do? The UN will work by majority. With a majority, you talk. You don't get common rules. And at the time of fragmentation, you may say this is what we should do, unilateral measures. You may unleash something which will look like chaos. What the UN could usefully do that the OECD didn't do enough is trying to provide rules for the least developed countries, or trying to provide rules which work when you have a tax administration which is not as sophisticated or as well equipped as other countries. What the UN can usefully do is maybe focusing more on what you, rightfully through the Platform for Collaboration on Tax, advocated, which is an agenda maybe more focused on source taxation, on natural resource taxation, and this type of thing. So an agenda, and I think it's fine that the UN develops an agenda which will make developing countries feel more at home. That's the third option among the three options proposed by the Secretary General of the UN. I think the worst case scenario would be a war between these two organizations. There is room for everybody, as we should. You know, you and I, we kind of created the Platform for Collaboration on Tax back in 2015. It was in Peru, back to the IMF fall meeting, right?
Happy days.
Yes, happy days. So there is room for everybody. The UN should definitely push for the agenda of developing countries. This should not undermine what has been achieved at the OECD, what can go on at the OECD as long as it is inclusive. And maybe the OECD could do better in the way it organizes the work. in the way it structures the work so that countries feel more at home. So instead of competition, opposition, and there, the NGOs, I think, are wrong and bear responsibility by being too negative. There could be something more positive. We don't need wars. That's where we're heading. Right. We need cooperation.
Very good. Well, we're slightly over time, but I have to ask you one final question, which I don't know if you sent this in yourself while I wasn't looking. It says, any recommendable books or other information sources relevant to what you talked today? Of course, your book is a must-buy. So.
Yes, so I wrote a book, which is Tax Havens, How We Changed the Course of History. Sorry for the title, not mine, the publishers. But this book is in French only, so you have the choice to learn French, which is good, because it will give you access to my book, or you wait for the English translation, which will come. But I think there is another great book on destination, so you may want to mention it.
Oh, this book has the advantage of being free. There's the book edited I guess by Mike Devereaux on taxing profits in a globalized world, which talks about some of these issues. But
I mean, you're too modest. It's the book where you will find the concept of the destination-based.
Yes. But well, with that, it just remains for me to thank you very much, Pascal, for coming along. It's been terrific, and good luck in your future everything's.
Thank you so much, Nick.
Thank you.
Thank you.
Thank you.